I know a lot of people are under the impression that we have a rock solid banking system in Canada, but you don't have a rock solid banking system when you allow lending to this many people who cannot afford to pay you back and are just relying on the greater fool theory. It's according to RBC, over $300 billion was wiped off Canadians' net worth in 2023. What's going to happen in 2024? And this follows, remember, after 2022, when a record amount was wiped off their net worth then. We're also going to get into housing affordability and what is happening there. And also, cash for keys is now on the rise, but it's not what you think. Canadian household debt service ratio hits record high, set to rise further. This comes from RBC. So new research from RBC shows that Canada's household debt servicing ratio hit a new record in Q3 2023 as previous increases from the Bank of Canada trickle their way through the economy. The debt servicing ratio rose to 15.2% in Q3 from 15.1% in Q2. The report notes Canada's household debt levels are high and increases in interest rates continue to pass through to debt payments with a lag. The household debt service ratio is already at record levels and will move higher as debt payments continue to rise alongside wobbly looking labor markets. And we certainly saw that last week, didn't we, guys, with the labor market report? If you haven't seen it, I'll link it at the end of this episode. But yes, we are having a very bad labor market. We have 2 people for every 1 job that is currently posted, and they continue to just bring more and more people in every single month. That is just getting worse. And the data that the government provides, it doesn't even show us the main story and the true story, I believe. It is insanely manipulated. Let's continue on here and see what's going on. So other key findings from the report show Canadian household net worth fell by $301 billion, minus 1.8% quarter over quarter, pulling back due to a surge in bond yields and an underperformance in equity markets underperformed. That doesn't make sense. But anyways, that amount of money was wiped off Canadians' net worth, and that was purely just because interest rates went up. And remember, the Bank of Canada does not control the entire interest rate curve. They only control the front end of it. So that's what they're referring to when they're talking about bond yields in particular rising, because that means bond prices are actually going down. Now, we've actually had the flip of that in Q4, which was bond yields were actually going down, bond prices were going up. So there will be a slight rebound. But what I want to show you is that volatility in Canadians' net worth is at an all-time high right now, because essentially the net worth is based off a housing bubble. It's based off hyper financialization of the housing market. So it's absolutely crazy. And it even shows here that it's still way above 2019. So a decline in home prices also pressured net equity in real estate, which also fell by 1.7% as home prices edged lower. Since its peak in Q2 2022, home equity is down 10.3%. For context, however, home equity remains 57% higher than pre-pandemic levels of Q4 2019. But will that last? The thing is, a decline of over 10% in home equity is the start of something, obviously. So we'll continue to see what happens with the housing bubble. We've got the emergence of cash for keys now, and this is actually happening in the rental sector, guys. But we should listen to this, because the financialization of the Canadian housing market, what most people don't realize is it is actually heavily dependent on renters paying their rent, because most of the people in the Canadian housing market, a lot of them, a massive percentage that has driven the prices to levels that none of us would thought they would be able to reach, are investors and speculators in particular who rent out their properties and rely on that income and are absolutely leveraged, generally holding more than one property, as we've seen in the Better Dwelling report. So bear that in mind as we go through this. Instances of landlords offering cash for tenants to vacate a unit have risen in Toronto, according to real estate professionals in the city. Real estate experts say the practice is still relatively uncommon, but they have been seeing it more and more frequently in Canada's biggest city as landlords face financial pressures such as high interest rates. But not only that, the reason why this is happening is essentially because of bureaucracy, because of all these rules that Ontario and Toronto have in place when it comes to landlords and tenants, and it basically makes it very hard to evict renters. Now, that also has its own set of problems, because when your renters stop paying your rent, it becomes hard to kick them out as well. And even if it's not hard, if it just takes a significant amount of time, that time can eat into somebody's budget pretty quickly, especially if they've renewed into these higher rates. So bear that in mind. It's kind of crazy that we're starting to see that phenomenon happen, and I think it will continue and in fact get way worse, especially when renters stop paying their rent, which is already starting to happen. So the Bank of Canada Housing Affordability Index at second worst level ever. The Bank of Canada's index looks at the share of household income required to service a mortgage. Cost includes monthly mortgage payments as well as some utility costs. The higher the index, the greater share of income a typical household would dedicate to shelter when buying a home. And right now you can see how this is essentially even above, it's well above back in 2008 around this level here. We're now at 1990s levels. Now, this is concerning for a couple of reasons. Obviously, we've got the yield curve inversion right now, which is as inverted as back in the 90s. And as a lot of you have even commented who went through that recession in the 90s, you yourselves can actually see the parallels between then and now with this upcoming recession. So it's likely to be a lot worse, in my opinion, than 2008 and 2009. This is going to be particularly bad because of the debt levels that we have are just so, quite frankly, insane. They're going to have some impact on the banking system. I know a lot of people are under the impression that we have a rock solid banking system in Canada, but you don't have a rock solid banking system when you allow lending to this many people who cannot afford to pay you back and are just relying on the greater fool theory. It's just never going to work, is it? But people get lured into this false sense of security. So the Bank of Canada's Housing Affordability Index took another big step on the wrong side in Q3, says Douglas Porter, chief economist at BMO. Since then, we have seen a frenzy of speculative buying as rates were slashed to record lows, a surge in population, and then a spike in borrowing costs. And that exactly kind of describes the demise of a bubble, doesn't it? When you really think about it, all those different scenarios, they don't sound like a situation that is very stable, do they? They sound like an incredibly volatile situation that you would expect to be quoted when we look back on this in 20 years and we say, yes, this was the Canadian housing mega bubble, and basically it was caused by these things: record low interest rates, a population spike followed by interest rates being cranked up way higher than people are used to who took on debt during the low rates. Because you have to remember, most people in Canada took on debt during low rates. There's barely anybody, and even if those people have mortgages, they've levered up on home equity or they've refinanced their homes. That's why the mortgage debt chart is going up so much. And the chart I'm referring to is, of course, this chart here. You can see that it is around 2004, 2005 when this thing starts to go parabolic. And that's when I classed the start of this bubble actually happened, because it wasn't in 2008. It's when the debt leaves the historic trend. So people are taking on more and more debt, and it just so happens that that debt was being allocated towards real estate. It could have been going into stocks. It could have been going into anything. It's just in this case, it was a real estate bubble, and most of that money went into real estate, unfortunately. Huge malinvestment, because if all that money had gone into the economy in some way, it might have created many businesses. It might have created more general prosperity in Canada. Instead, it's mostly just been plumbed into real estate, which just isn't productive long term. So it's kind of funny what BMO is saying. One insight that may jump out at even a casual observer is the sharp decline that typically happens after affordability reaches this level. Affordability suddenly improves after a brief stay at this level, which typically marks the popping of a bubble. Looking ahead, note that the three prior spikes in unaffordability, early 1980s, early 1990s, and 2007-2008, were followed in short order by Canadian recessions, Porter notes. As shelter costs rise, it diverts funds from more productive areas like investing in consumption. The result is households have lower cash flow, leading to shrinking revenues for businesses. Porter adds, we expect the economy to struggle to grow in 2024. So with the chief economist at BMO saying all these different things. Wouldn't you think that BMO would listen to that guy and they would say, hey, we really need to tighten up our lending here and we really need to prepare for a crash? Now, one could argue that BMO is preparing in some ways. They are beefing up their cash reserves. But if you look at the amount of loans that they have, it is just a fractional amount. It wouldn't even be nearly enough if even 5% of the loans started defaulting, let alone 6 or 7%. So the amount that they hold on reserve is just not enough to cover, because this bubble has become so big, and this bubble is much larger than it was during the 1980s and the 1990s. And the reason is because the values have got so much higher. So the amounts needed are so much larger. So that makes the losses larger. That makes the profits also larger, which is what has driven this bubble up for so long in that low interest rate environment. So it is absolutely insane, but he is right to point to this chart and talk about it because the correlation is definitely there. You can see that after the 1980s right here, we went into recession and it came right back down. You can see the same thing happened in the 1990s. And obviously that wasn't a good time for Canadian real estate. And the 1990s was one of the worst recessions in Canada's history. And just bear in mind, the yield curve now is the most inverted that it's been since the 1990s. And the yield curve is right 99.9% of the time. And we've been through that many times on this channel as well. So anyway, I want to thank you so much for watching this video. If you're looking for a VPN, go to expressvpn.com/marketmania to get around Trudeau's censorship laws and Bill C-11. If you enjoyed this video, you might want to watch this video about the labor market, or you might want to watch this video about the yield curve. So I will see you in the next one. Take care. Bye-bye.